Good morning, everyone, and good afternoon, good evening, wherever you're joining from. I'm Sammy. I run the communications and marketing here at the CPA, dialing in from CPA headquarters in central London. It's nice to know that, the summer has sort of started with a nice sunny weather. I hope it's all good wherever you are. I know we have members joining from all over the globe, so we're very, very lucky to have you. Thank you very much for joining us. And we have Professor Noble Francis, who runs our economics department here at the CPA, who will be running through today's webinar on the summer forecasts. So just some quick ground rules, if this is your first time around this area. So the Q&A box will be live. So obviously, please feel free to share your questions beforehand or afterwards or during the presentation. And Professor Noble will be answering those questions at the end of the webinar. So we have plenty of time for that. But also, if we do not get time to answer all your questions, we will endeavour to get through as many as possible. The recording for this will be live on the CPA website in the next 48 hours, which you can check out, and we shall also be sending that link via email. So without any further ado, it's over to you, Noble.
Thank you very much, Sammy, and thank you to everyone for attending this webinar. 2 points I should just make before I start. If you look at construction activity so far this year, it's been more volatile than normal and unseasonally as well. So what most of the firms that we've been speaking to have found is that you have a couple of good weeks and then there's a sudden drop off and then things pick up, but it's difficult to identify very clear trends according to most of the firms we've dealt with. But the sense we have from most of the firms we've dealt with are that activity was picking up in the first quarter of the year, but then April was dire. May, there was a pickup in activity, and that's despite the additional bank holiday, which we thought may affect things because of the loss of a working day. But May was actually surprisingly good, as was early June. And then the second point I'd like to make before we get started on the slides is that how you find the construction output forecasts in terms of the extent to which it affects you will depend upon what part of the construction process you're involved in, you're feeding into. I was presenting to firms that work on the electrical side yesterday, and for them, clearly with construction output, they tend to be towards the mid-end of the construction process. So there's a bit of a lag between how they will find our construction output forecasts and the impact on them. Okay, after that preamble, I think it's worth me loading up the slides, and I'll switch off my camera. And hopefully you're able to see my slides.
Yep, we can see that, Noble. Thank you.
Thank you for confirming, Sammy. Okay, so as per usual, I'll start with just very briefly a couple of slides on the UK economy. And it's worth highlighting from a UK GDP perspective. On a monthly basis, GDP is bouncing around. In April, GDP rose by 0.2%, but May it was 0.1% down. So it's flatlining, but it is slightly volatile around that general flatlining trend. And we're expecting it to flatline for the majority of this year. GDP in Q2 is likely to be somewhere between minus 0.1% and plus 0.1%. So again, it's that general flatlining story. In terms of the concerns around a general economy recession, the majority of forecasters don't anticipate a recession this year. But it is worth noting that for most of the macroeconomic forecasters, their forecasts were done before the market expectations of interest rates rose significantly. On the positive side, despite all the negativity that we've had so far this year, but also in Q4 last year, post mini budget debacle. Despite the cost of living rises, despite the rise in interest rates, consumer spending has actually been sustained relatively well, and consumer confidence has risen each month this year so far. Now, on the positive, households still have £200 billion worth of savings in the UK. So that could be used to sustain spending further despite increasing interest rates that are expected to increase further in August. Households haven't really been dipping into those savings so far, those savings that they accumulated during the pandemic. And what it appears to be is that those savings are generally held by those middle income and wealthier part of the population. So what that means is, despite the cost rises, they've been able to sustain spending irrespective of needing to dip into the savings. The problems are for the poorer part of the population who didn't accumulate those savings during the pandemic and are suffering more from the cost rises. In terms of our GDP forecast, this is GDP on a quarterly basis. The green line shows what our spring forecast was, and what you see in the blue line is our summer forecast. And there isn't too much difference between them, but it's worth making a couple of brief points, which is that our spring forecast was here for the early part of 2023. The summer forecast is slightly above that, and that's because GDP data covering the first quarter have actually surprised on the positive side. Despite the interest rate rises, consumer spending has been sustained, and consumption accounts for over 3/4 of the UK economy. But what we are anticipating is that as interest rates rise further than we expected back in the spring, then that will slightly hit GDP towards the end of this year and in early next year, before we see recovery. And it's worth noting that when we did the forecast back in spring, market expectations and the Bank of England's expectations were that interest rates were already at peak at 4.5%. And then 1 month later, market expectations rose of peak interest rates above 6%. Now, what we've assumed in the summer forecast is that interest rates won't reach 6%, that they'll peak at 5.75% at the end of this year, and then in the second quarter of next year start to fall. In terms of the balance of risks on the UK GDP forecast, we have both positive and negative risks. It's clearly easy to focus very much on the negative risks because the potential is that interest rates may go higher than we expect. And so our lower scenario does entail a significant recession and interest rates going above, significantly above 6%, up to 6.5%. But it is worth noting that there are still positive risks there. And as I mentioned, for all the negativity, the negative news, the cost of living crisis, the interest rate rises, consumer spending has surprised on the positive side. And so that could continue to occur throughout this year and early next year. And if it does, then we end up with the green dotted line, which is GDP remaining broadly flat for most of this year before recovery at the start of next year. Okay, that's all I want to say on the UK economy at this stage, but I'm happy to answer any questions about it in the Q&A. In terms of total construction output, according to the ONS data, the Office for National Statistics data, total construction output volume rather than value, volume, was 0.2% lower than it was in April, but it was still 0.2% higher than a year earlier, and it was 4.9% higher than in pre-pandemic. So overall, total construction output is still at a relatively high level, but that overall figure masks large differences between the different sectors. And what I've highlighted here is 4 of the key construction sectors, just to illustrate the key difference between how some firms will be finding things down on the ground in terms of demand. Now, if you look at infrastructure, you can clearly see that output is significantly higher than it was pre-pandemic. And in May, infrastructure was 28% higher than pre-pandemic. Industrial reached its highest ever levels on record a few months ago, and despite a relative slowdown in the last couple of months, output in industrial, which is primarily factories and warehouses, was still 19.6% higher than pre-pandemic. Now, those 2 sectors contrast sharply with private housing, where output in May was 8.4% lower than it was pre-pandemic and 14.6% lower than a year ago. Clearly, there's a peak level just before the full impacts of the mini budget and the spikes in mortgage rates that occurred afterwards. And so it is on that downward trend. And that won't be a surprise to any of you involved in house building. It's also worth highlighting commercial, which is primarily offices, retail, hotel and leisure and entertainment. Commercial output in May was 29.5% lower than it was pre-pandemic. Now, digging below the overall commercial figure, it's worth highlighting that those firms who are involved in building new build commercial towers will have taken the biggest hit and found that activity is about 1/3 lower than it was pre-pandemic. However, that is partially offset by a smaller part of the market, but one that is incredibly robust at the moment, which is refurbishment, fit out of existing commercial office developments, meeting that demand for grade A office space. And that is boosted further by the changes in use of existing commercial developments into residential and into industrial and logistics. It is worth noting, I left out of the previous slide, private housing, repair, maintenance and improvement, which is the second largest construction sector. And the reason I left it out of the previous slide is that we've been highlighting over the past year issues we have with the ONS data on private housing RM&I. The indications we have from firms down on the ground, so that's builders, merchants, small contractors doing refurbishment work and improvements work. The indications we have from the supply chain are that RM&I activity enjoyed a surge in activity in 2020, 2021, and early in 2022, up until around March 2022, and then started to fall from then on. However, the ONS appears to be having issues with its RM&I output data since around March last year, and it appears to be overestimating the level of volume of construction output in RM&I, and that's why the ONS reports that in May, our private housing RMI output was 43% higher than it was in January 2020, pre-pandemic, which is not in line with any of the indications we have from industry. The reason that the ONS appears to have issues with its volume of private housing RMI output data is because it appears to be underestimating the extent of price inflation in RMI. And according to the ONS, price inflation in RMI peaked last summer at 7.2% and has been slowing since then. According to firms down on the ground, whether it's builders, merchants, smaller contractors, RMI inflation was more than double what the ONS is reporting. And because the ONS appears to be underestimating the amount of price inflation there, it's consequently overestimating the volume of activity. Right, away from the ONS's price inflation issues, if we look at the new orders data, clearly new orders tend to bounce around a lot because they're highly skewed by big one-off contracts. And you see that back in 2017 when there's a big spike in new orders due to the HS2 contracts being signed originally, but clearly the activity from that continues over a long period of time. But it is still worth looking at the new orders despite this. And what's noticeable is how they were bouncing around, but they were pretty much around the 2015 to 2018 average during 2021 and 2022, up until they hit a peak in summer last year and then have been falling away since. After the mini budget debacle, then we saw a rise in economic and political uncertainty, and clearly we've seen sharp downturns in housing since. And that's one of the key areas where we see the new orders falling. And what I've done in this case, because the new orders tend to bounce around on a quarterly basis, I've done the 4-quarter total for new orders up to the 4 quarters, including 2023 Q1, and then compared it with the previous 4-quarter total. And what's noticeable is that within that overall sharp fall in new orders, there are clearly big falls on the commercial side, but again, that's the new towers projects rather than refurb and fit out. And unsurprisingly, there are sharp falls there on private housing new build. It is worth noting there is a significant fall in infrastructure orders, but primarily there tends to be a lag between infrastructure of between 12 to 24 months on infrastructure, and a lot of work is based upon either big one-off projects like HS2, Thames Tideway, Hinkley Point C, or because of framework programs where contracts are signed up to very early, and so the activity is likely to continue for a considerable period there. It is worth also highlighting public non-housing, which is primarily education and health, where there are contracts signed up to in the school rebuilding program and the new hospital program, but it may take longer to come through than expected. There have been persistent delays there and changes in spec, repricing, etc. Okay, so a lot of this has been to highlight the general conditions within the industry before we get into what the forecasts are. And so what I'd like to highlight in terms of the forecasts is we have illustrated here just the key sectors. I'm not going to get into any of the subsectors, but if you want me to drill down into any of the detail, then feel free to ask me after the presentation. We do have time for Q&A, as Sammy was highlighting. The green bars on the chart here illustrate our spring forecast, and then the blue bars illustrate our summer forecast. Overall, in total construction output, we do have a slight downward revision. Back in spring, we were forecasting a 6.4% fall in volume of construction output this year. Now that's a 7% fall. It is worth noting that when we were forecasting back in the spring, we did get a little bit of criticism after we published for being too pessimistic, primarily because activity was starting to improve in some sectors like private housing during the first quarter. But I think that was more a blip in between the sharp fall in demand in housing in Q4 and then the sharp fall in housing demand that we're seeing at the moment. Within our 7% fall in total construction output this year, it's clearly skewed to certain sectors. And it's worth highlighting private housing new build, where we have a 19% fall in output. That's also reflected in a 19% fall in completions. But it is worth noting that because of the high degree of uncertainty for house builders at the moment, there is a greater impact on starts. So private housing output and completions we're anticipating will fall by 19%. Starts we're anticipating will fall by 25%. From the house builder perspective, after the spike in mortgage rates in October, November time, we saw demand at the end of last year fall by around 30 to 40%. Demand picked up in Q1 this year as mortgage rates began to fall. But since May, mortgage rates have been rising again. And because of this, we're seeing that some of the house builders are expecting to have effectively a summer pause whilst they focus on completions. They're not looking to start any significant new developments, focus very much on completions. And what they're trying to do is assess what the real level of demand is likely to be once mortgage rates settle. What that means is that we've seen falls in house building so far, primarily on the start side, but we're expecting to see that lead to a further fall in completions in the second half of the year. We may see some help for first-time buyers in the autumn statement, but that's unlikely to have an impact on activity this year. It's more likely to lead to a greater amount of confidence and a boost to demand next year. It is worth highlighting that as well as the fall in demand, house builders are also suffering from a raft of issues on the supply side. So up until recently, cost inflation was a major issue for them. In addition to that, planning, as ever, has been an issue. And then exacerbating the planning issue has been the water and nutrient neutrality issue, which is making planning more difficult and more costly as measures are introduced to deal with that. And it's worth noting that these issues impact the smaller house builders even more than the large house builders. And clearly the smaller house builders are more affected by the fall in demand as well, given their business model. It's worth highlighting on the public housing side, we have a significant fall as well. Now, social housing demand is relatively poor, but more broadly, affordable housing demand remains relatively strong. Part of that may be some home buyers that would have purchased private housing new build, moving more towards the shared ownership affordable housing model, given that affordability is an issue increasingly now. So affordable housing demand remains relatively strong. The problem for housing associations and for local authorities is that their demands are much more on the existing housing stock. So what they're having to do is shift finance away from new build, particularly given declining grants, particularly given that homes that they would have built for sale, the demand has fallen there. Housing associations are having to shift their constrained resource away from new build to deal with the existing housing stock. And in terms of dealing with the existing housing stock, what that means is that private housing RM&I is likely to increase in volume this year. And that's because housing associations and local authorities not only have to deal with issues to do with decarbonisation and also building safety, which have been there for a while, but increasingly they have to deal with basic living conditions such as mold, which has become a major issue since October last year. And no CEO of a housing association wants to be on the front pages of the newspapers or named and shamed by Michael Gove. In terms of other sectors, it's worth highlighting private housing repair, maintenance and improvement. In spring, we had a 9% fall penciled in there for this year, and we have a slight revision downward there. In terms of private housing RM&I, then I mentioned earlier that activity fell away from March last year. That tended to be the smaller discretionary improvements works, given that a lot of homeowners were facing increasing interest rates, real wage falls, cost of living rises. Then what we tended to see from March last year is that homeowners were pushing back or cancelling smaller improvements works last year. Activity on larger improvements last year appeared to continue, mainly because households had got planning permission at the start of the year and they had the finance allocated, and they were worried that if they delay the projects, they would just get more expensive. But whilst larger improvements projects continued last year, planning applications for new improvements projects fell by 19% last year. And so that 19% fall in planning applications for larger improvements works last year is likely to lead to falls in activity this year. But as you can see, we don't have a 19% fall, we have an 11% fall. And that's because that sharp fall in large improvements works this year we're expecting to be partially offset by increasing work on energy efficiency retrofit, such as insulation, and solar PV, which has exponentially increased in demand over the last 18 months. And that comes from two perspectives. Firstly, the rise in energy prices and concerns about energy security has led to an increase in demand for energy efficiency retrofit and solar photovoltaic, but also you're seeing homeowners that would have done other types of projects reprioritizing their spending in this respect. In terms of other sectors, it's also worth noting that public non-housing, so education and health, we have a 0.3% growth in there for summer. So effectively, we're anticipating that public non-housing is likely to be broadly flat, and that's despite the fact that we have programs in there, the school rebuilding program, and we have the new hospital program, the 40 new hospitals that aren't new hospitals, they're extensions or they're major refurbishments. So the programs are there. The problem is when they're going to come through, and we've seen these programs dogged by persistent delays and changes in views from clients that they're hesitant on signing off the actual projects. Where they have signed off, they are asking for repricing. They're concerned about costs spiraling out of control and whether the budget they've allocated will be enough. And that's primarily because on previous school and hospital projects, there have been significant cost overruns, particularly in the last 18 months. It is also worth highlighting on commercial, where we're anticipating 3% fall in activity there. Again, there's a big difference between the different parts of commercial, where commercial activity is still very strong and higher than pre-pandemic on fit out and refurb of existing office space, bringing it up to grade A office space, and also conversions of existing commercial developments into residential, if it's in an urban centre, that sort of John Lewis type change in business model, or changing commercial into industrial and logistics if it's on the outskirts of cities. That activity remains high as well. And you also have strong activity on data centres and biotech. The issue in commercial, as I mentioned earlier, is the new towers projects. There are a few towers projects in the pipeline, but nowhere near as many as were there 5 years ago. And so as those existing projects down on the ground have finished, then there's a lack of new projects to replace them. It is also worth highlighting industrial and focusing a little on that, which is that industrial demand is still very strong for warehouses and for logistics. That was driven by the long-term trend away from in-store retail to online shopping, which also was exacerbated by a short-term spike during the pandemic as online shopping increased temporarily to a third of total retail sales. That spike appears to have finished now, and so although industrial warehouses is at its highest ever level, new investment appears to have peaked in warehouses. There are still some big projects coming in, but not as many as were signed off 18 months ago. So after this year, we're likely to see that warehouses activity down on the ground will fall away from historic highs. And then on the factory side, it's worth highlighting that factories had a very buoyant 2022, primarily based upon the fact that in 2021 autumn, manufacturers were facing strong demand, they were facing capacity constraints, and so they signed off expansion plans for additional capacity or new factories. What we did see, though, is that as those projects finished last year, new investment plans weren't signed off in autumn last year. And that's because after the mini budget, there was a lot of concern around the UK economy. There was a lot of political uncertainty. And so it's hard to justify signing off investment plans for new factory space, which is high investment up front for a long-term rate of return. So factories activity peaked at the end of last year and is starting to fall away already. Okay, if we look at 2024, then In spring, we had 1.1% growth. That's slightly revised down this year in the summer forecast to 0.7% growth. So it is only a slight revision down, but it's to reflect the impacts of greater interest rate rises this year, and so the impact on UK economic growth. Across the sectors, it's worth noting that we are expecting growth in most sectors next year. The exceptions to that are industrial, where we're expecting growth this year in industrial to be sustained, but then we are expecting both factories and warehouses construction to fall away from historic peaks next year. So the 9% fall looks bad, but it's coming from historic highs. So the level of industrial output will still be relatively high next year. Then on the public housing side, we're likely to see further falls in activity on new build, based around the fact that housing association and local authority priorities will remain next year on the existing housing stock. Building safety, decarbonisation, and also basic living conditions. It is worth noting that we do have growth in private housing next year, despite the higher peak in interest rates, but we're expecting slower growth and from a lower base. So we're only expecting 2% growth in private housing. And given that we're coming from a lower base after a sharper fall this year, that 2% growth in output and completions is primarily in the second half of next year. I won't spend a long time on the rest of the forecast for next year, primarily because there's still a lot of risk around our forecast for next year. It is worth noting there are both positive and negative risks out there. As I mentioned around the UK economy, consumer spending has actually held up better than expected so far this year. And so if it does for the rest of the year and into next year, then the economy may be in a better place. And if the economy is in a better place, then new housing and housing RM&I may be in a slightly better place as well. Conversely, if interest rates do rise above 6%, then that would impact housing prospects further, not only in terms of the general housing market and private housing new build, but it would also impact upon private housing RM&I as well. Fewer housing transactions would mean less of the refurb that comes from those people that move home and then decide to refurb within 6 to 9 months of moving into a new property. On the positive, we may see stimulus for construction generally, but in particular for housing near term. But if we do see that stimulus, it's more likely to be in the autumn statement, so that stimulus would primarily impact next year rather than this year. We clearly had Michael Gove, the Secretary of State for Levelling Up Housing and Communities, making positive statements yesterday regarding 10-point plans for housing, easing planning, which is what government always says it's going to do, but the ease in planning is more likely to impact upon changes in use from commercial developments into flats rather than new build housing, which is where our primary interest is. On the negative, labour availability still is a major issue for some key skilled trades and specialist engineers, and that's despite slowdowns in demand in some areas such as housing, new build and RMI. Some more modular firms have been getting into trouble this year, like L&G Modular and Ilke Homes. Modular clearly has business model issues based around the fact that it's manufacturing, so it's high investment upfront for a long-term rate of return. It doesn't deal well with volatility in demand. As it happens, the modular firms that got into trouble last summer and this year have primarily been based around supply or quality issues rather than the demand issues. So we may see some more modular firms get into issues later this year, but that is very much on the modular firm side, which is a niche of offsite manufacturing. Some areas of offsite manufacturing, like timber frame, are seeing new investments going in there. Materials and product supply, which was a major issue in 2021, has actually eased significantly. So that is a positive. There are still issues from products that require a microchip, so smart meters, EV chargers, boilers, heat pumps, but those have largely been factored in to business models by planning in advance, particularly by larger firms. So materials and product supply is not so much of an issue. Cost inflation is slowing, which is positive, and I'll just make a couple of comments on that, because although cost inflation is slowing, that's the rate of price rises. So what it still means is that price rises are still high. And if we look at materials price inflation on an annual increase basis, then in the year to May, materials prices were only rising 1.5%. And that clearly contrasts sharply with materials prices in the year to June last year, where prices were rising at 27%. But the problem is, even though materials prices only rose by 1.5% in the year to May, that still means that materials prices in May were still 44.6% higher than they were in January 2020, pre-pandemic. So the aggregate impact of the consistent price inflation issues over that period of time, initially due to the supply chain issues after the lockdowns, but then because of Russia's invasion of Ukraine and then the spikes in energy prices, mean that materials prices in May 2023 were 45% higher than pre-pandemic. The key impacts of this are on the specialist contractors. Overall, if you look at the 12 months to May this year, then 4,209 contractors went out of business in the year to May. And that's the highest number since the financial crisis, going back more than 10 years ago. More than that, the biggest issues are clearly on the smaller specialist subcontractors, and 59% of the subcontractors that went out of business in the year to May were specialist contractors. They're not only hit by the cost inflation, but they're also hit by other issues such as IR35, reverse charge VAT, the rise in personal indemnity insurance, planning issues, and they're also impacted by the sharp falls in demand on the RMI side, but particularly the housing, private house building side as well. So just as a quick summary, it's worth highlighting that overall construction demand is still strong. This isn't 2008, but it depends which sectors you're operating in. And if you're operating in private housing new build, particularly going in at the start side of things, then you will have seen already a sharp fall, and there's likely to be further sharp falls this year. And if you're operating in RM&I, then there's likely to have been a sharp fall as well. But there are some key areas of growth, and you're looking at those major infrastructure projects where if you're operating on HS2 between Old Oak Common and Birmingham, activity is still going very strong there. If you're working on Thames Tideway and Hinkley Point C, there's lots of activity there. If you're working on the frameworks that in regulated sectors like water, roads, rail, energy, there's lots of activity there. The problem on the infrastructure side is very clearly if you were working at Euston, or if you're doing some of the early work on HS2 between Birmingham and Crewe. If you're working on roads projects where there are pauses, or anticipating working on smaller roads projects in RIS 2, which are going to get pushed back into RIS 3, there's lots of growth there and strong activity on commercial refurb, and that's upgrading office space to grade A quality office space. There's also lots of work on the conversions of existing commercial space into residential or industrial logistics. There's lots of activity on energy efficiency and solar photovoltaic. That continues to remain strong, and we're anticipating it will do throughout this year. And then health, there is theoretically activity that may occur there, but it is highly dependent on when we see those 40 new hospitals that aren't 40 new hospitals, they're extensions and refurbs. When we see those projects that are there in the pipeline, when we see those actually coming through. Okay, I'm happy to finish there, and hopefully you have some questions for Sammy to ask. But it is worth noting that in case you don't feel comfortable asking questions in the webinar, then my details are here, and when the slides are sent out, you'll also be able to contact me on those details. I put the latest market intelligence data on Twitter and on LinkedIn as well, so it's worth noting those. And at this point, I'm happy to hand back to Sammy, and hopefully he'll be able to put a couple of questions. There's a bit of time left for the last bit of the webinar.
Yeah, thank you very much, Noble, for that. I can probably say that it probably wasn't as depressing as some of us might have thought it would have been. So it's good to see.
That's the way I lower expectations. It means people end the webinar thinking, wow, it wasn't as depressing as it usually is.
Well, I hope I'm not the only person. I'm sure most of us probably would agree, but we are here to answer any questions and queries you might have, as Noble has mentioned as well. Obviously, please feel free to follow him on his socials. We regularly retweet what he does well, so if you're not able to find him, you can search it through our LinkedIn and Twitter pages as well. Cool, so just diving straight into the questions. First question, Noble. So after the recent by-election results, we've already begun hearing from both major parties of a rethink around climate change and energy efficiency policies. For example, the Financial Times today quoted a government official saying that they support a delay to raising mandatory efficiency standards beyond the current 2025 deadline. Does the CPA economics team have a view about how all this could impact activity in these sectors?
Yes, and it's a good question. I think we're unlikely to see major impacts from changes or a bit more realism in terms of policies going forward. I think The by-election is slightly overplayed in terms of it. If you assume it's about the ULEZ that was won by the Conservatives in Uxbridge, ULEZ is about air pollution more so than around climate change. In terms of climate change policies more generally from government as a post by-election, you have seen that government's rhetoric has changed more towards net zero transition still occurring, but without so much of a burden on households and landlords in particular, given the minimum efficiency standards that will be coming in from 2025. There are issues from government's perspective that if it is going to be serious about net zero transition, whether it's Conservative or Labour, it will have to be more sensible about it. It will have to get the backing of the population. And so they will have to ensure that there isn't too much of a burden financially because of it on households. And it will have to be practical in terms of its deadlines. So all landlords bringing up their existing stock up to for new lettings by 2025, that's only 18 months away. And there are issues about whether the capacity is there to deliver that. And then for all lettings by 2028, it sounds far away, but it actually isn't that far away. And so from a practical perspective, being able to bring it up to EPC rated C by that time, there isn't the capacity from a labour perspective or a products perspective. And more generally, there is a greater issue that EPCs aren't designed for that. They don't measure energy efficiency very well. And the assessment of EPCs is relatively quick and brief. And there needs to be a greater thought about the process.
Quick question from Ian. As you point out, material price inflation has slowed, but prices are still high. Do you anticipate any deflation over the 23-24 period?
Yes, it's a good question, Ian. And what you see is that from that peak last year of 27% price inflation on the materials side, that's already slowed to 1.5% in the year to May. So what you would expect in the next few months is that you do see it going negative, but it's highly dependent on what materials you're using. So if you look at, say, for example, insulation in the year to May, we're still rising at 29%. But if you look on the other side of things, you've still got imported softwood falling at 27%. So yes, the overall figure for materials inflation will slow further and become negative. But whether you see that as a firm in the supply chain, whether you're a merchant or small contractor, will be highly dependent on the product mix you're using. If you're using imported softwood at the moment, you're already seeing negative price inflation. If you're using insulation or energy intensive products like RMC, ready mixed concrete, even though overall materials inflation will go negative, you'll still be seeing double-digit price inflation there.
Thank you, Noble. Thank you, Ian, for that question. Two quick questions from Liam. Do we see any impacts if a general election is announced in 24? And any view on construction output phasing in 24? Feels like it could be reversal of 23, i.e. tough H1, better H2 in 24.
Yeah, okay, I'll take the second one first, because that's an easy one to close off, because Liam's actually answered it himself, which is for the main private construction sectors like house building and private housing RMI, yes, you're right, tough H1, better H2. So that's your second question. First question, in terms of general election, a general election has to occur by January 2025. The greatest likelihood is that it will either be summer next year or, in our view, autumn next year. And so because of that, we're expecting policies to stimulate housing and construction more generally in the autumn statement. The big question is whether they will be announcements that sound nice, so public relations announcements, or will they be effective policies that actually stimulate first-time buyers who've been the most affected by the mortgage rate rises, and are there really going to be capital expenditure rises that would boost construction? And that will really determine whether we see a stimulus for construction and particularly house building in advance of the general election.
Thank you, Noble. Thank you again, Liam, for that question. Finally, Nick has asked, hi Noble, any view on house building output year on year in 23, H1 compared to H2?
Okay, in 2023, it's going to be an odd profile from our perspective, and what we're expecting is that starts in Q1 relatively poor, that there is a spike in starts in May and early June because there is the end of the 1-year grace period for the uprated building regs, which involve building regs Part L, Part F, Part S, and Part O, which, without getting into the detail of it, mean heating and ventilating is going to have to be uprated and involve more cost, and Part O, which involves EV chargers being installed in every new unit. So getting in ahead of those building regs, we're likely to see what we call technical starts, in a spike there in May and early June. So technically in the stats, starts will improve, but that's not likely to lead to an improvement in sales of products we would normally see going to the start of house building. And so in terms of the second half of the year, particularly Q3, we're likely to see that there's going to be that summer pause from the house builders. So the fall in starts feeding through, and we're likely to see a pickup at the back end of this year in completions, but from a low point to meet year-end deadlines.
Thank you, Noble. I think that's all the questions that we have for now, with 1 minute to go, so very timely. Just want to also just remind you all as well that this recording will be available in the next 48 hours, along with Noble's presentation slides. But also just one for you to think about is on the 7th of August, we'll be publishing our construction trade survey. So again, for those of you who are new around this area, so we provide sort of a quarterly and pan industry assessment of current and expected conditions within construction, which analyzes a range of independent surveys, which range from building contracting, specialist work, civil engineering, product manufacturing. So it's basically an overall overview of the whole industry, of sort of one convenient document for you as well. So that will be on the 7th of August. So we'll send out the relevant comms around that, so you'll be able to download it, obviously, for CPA members as well. So yeah, thank you very much for your time. We really appreciate it. Thank you again, Noble, for your presentation. We hope you've enjoyed it. Thank you very much, and hope to see you next time.